So it's only just starting. The fact that the retail market has been sellers this year, while the professionals have been buying, is actually the clearest indication that you've got that this is in the very, very early stages of a big bull move.
The selling has been stronger than at any time since 2017, but so too has very large purchases by people who understand what's happening. So the person looking to make a profit, which I think is not the reason to buy gold and silver, they're looking elsewhere. But the trend that I see is of the public looking elsewhere as the insiders are draining the exchanges.
So I came up with the phrase triple-digit silver, and I see it's being copied now a few times. I'm no longer the only one saying it, which is nice to see. And I think we'll see that in the silver market, because it's such a tiny market. We're producing 830 million ounces. You multiply that by the current metal price, call it $30, and it's what's that work out to? That's 15, well, more, about 20 billion a dollar market. How many times can that fit into Apple or Tesla or Nvidia?
Before we dive into the best clips of the week, make sure to smash that subscribe button.
The only people who participate early in the next bull market are basically the people who really know what they're doing. They're real pros. The guys, for example, sort of in, let's say the mining industry, something like that, who understand mines, they're in there buying stuff and it's sort of accumulating in their hands. You get M&A activity. This sort of thing begins to build. And as the M&A activity begins to build, then you find that there's a wider investment community. But again, very much investment managers, experienced guys who will go in and drive the second wave. And towards the end of the second wave, some of the public begin to sort of think, markets are going up. Perhaps we ought to buy some. You then get another correction. I mean, Elliott Wave fans will know, will feel the description. But then the last bit is the last bit of the bull market is where all the idiots, who've missed it, pile in because they know they're missing something and it's going up and they buy it just because it's going up. Now we are, if you like, in those terms, in phase one. And so to see the public selling while the professionals are buying, which is what Andy was saying, is exactly what's been going on. It's that very, very early stage. You can take these comparisons a bit too far because obviously we're not talking about investment, we're talking about protection. And we're talking about getting out of credit and getting into money. But the psychology basically is the same. I mean, even Germany, who's had two wipeouts, currency wipeouts, since the 1920s, 1923 and also following the Second World War. I mean, they're not buying gold. People are not buying gold. They're not sort of putting some aside. They've been selling. And if you look at, ETFs, the dreaded ETFs, which are not a substitute for gold or silver, it's only recently that there has been a little bit of buying, if you like, in Western capital markets. But that buying hasn't been really individuals. It's been some of the funds, run by guys who maybe listen to us a little bit and have got this sort of idea that gold is actually something you should have, or a little bit of silver if you want to speculate on EV and all this sort of stuff. So it's only just starting. And so really to summarize, the fact that the retail market has been sellers this year, while the professionals have been buying, is actually the clearest indication that you've got that this is in the very, very early stages of a big bull move. Well, I think what the banks are doing is what they've also been doing in 24. That is, they're trying to de-risk their balance sheets. Now, an individual bank can reduce its balance sheet. Point being that the leverage within the banking sector is uncomfortably high, and it became uncomfortably high because margins were suppressed at the time when we had zero interest rates. And if you look at the banking systems in Japan and also in the Eurozone, where they went, where the central banks drove interest rates into negative territory, I mean, the leverage there is far greater. So, leverage is a function, if you like, of how the banks responded to the suppression of interest rates. So they're now left with higher interest rates and too much leverage on their balance sheets. They're trying to reduce that. The system as a whole cannot reduce its balance sheet for the very simple reason that once credit is created, it doesn't disappear. I mean, people make the mistake of thinking that, we get into a deal, we do the deal, I pay you, you deliver to me, end of credit. No. What happens is the credit gets passed on to other parties. If I pay you, it goes into your bank account. And if you pay someone else, it goes into someone else's bank account. All that's credit. And even cash is credit. It's not proper money.
In the continuation of the episode, Alasdair Macleod shares his insights on the BRICS nations and their growing influence on the global economy. He discusses their efforts to challenge the dominance of the US dollar, the implications for the gold market, and how their push for a new reserve currency could reshape international trade. Macleod breaks down the potential impact on precious metals and what it means for investors in a rapidly shifting economic landscape.
Well, I've come up with many phrases throughout my, 21 years running this company, strategic metal, there's no substitute to silver. Copper's the highway, silver's the glue, which was one of the newer ones I've come up with because, you look at a device, any kind, it could be electric car, computer, cell phone, a toaster, a refrigerator, a freezer, whatever the case may be. There's copper in all those components, but it's glue that it's silver. That's the glue that holds it all together. So it's extremely important metal. And when silver went to 50, because I was calling for $50 for the first 10 years of running this business. And then when it went to 50, like the banks, BMO, I remember reading all these research reports, and I think BMO stands out. And they had a $70 target on silver. And so, I figured, geez, $70, that's pretty conservative. Because I looked at the mining ratio and I looked at the gold price, and then I said, we need $100 silver, just to justify the mining industry to go after silver to increase production, because the mining sector is not going to do it unless we have sustained higher prices. Because even at $30 silver, the margins aren't there to really give us enough profit to go and invest the billions of dollars necessary to get more silver into the marketplace. And so I came up with the phrase triple digit silver, and I see it's being copied now a few times. I'm no longer the only one saying it, which is nice to see. I was the first to say it, but I think we'll get there. I think, you look, it's a simple math. You call it 10 to 1 because it's easier to calculate. But you talk about $2,700 silver divided by 10, that's $270 silver. Now, I've never suggested $270 silver, but really, if you look at the mining ratio, that's where it should be. So triple digit, $100+ silver should be easily achievable. Being a trader, on the floor of the, Vancouver Stock Exchange for 6 years, and, I see markets that are not perfect, because there's too many sellers or sometimes there's too many buyers. And it takes a while. That's why exchanges halt stocks sometimes, because if a stock goes down too much or up too much, the exchange will step in. They'll halt the stock and wait for an equilibrium to occur, and then they'll reopen it for trading, a few hours later or maybe the next day. And because the whole concept behind that is, to kind of smooth out those major ups and downs that occur in all markets. And we saw that in the nickel market. The LME halted the nickel market for, I think it was a week, until they could try to figure out how to bring some equilibrium into that market. And I think we'll see that in the silver market, because it's such a tiny market. We're producing 830 million ounces. You multiply that by the current metal price, call it $30, and it's what's that work out to? That's 20 billion a dollar market. How many times can that fit into Apple or Tesla or Nvidia? Then any one of those companies can buy the entire silver market in one fell swoop, just with the cash on their bank. And I think that'll happen. And I've been also, I've said a number of times over the last several years that, I think the mining sector will eventually get bought up by the high tech sector, because they need the metal. And we've seen Elon Musk make a couple of investments in lithium and nickel. It's early days, but I think that the mining sector, or pardon me, the electronic sector will come in and start buying up some of these mining companies.
In today's news recap, silver price surge expected in 2025 as UBS predicts $38 target amid industrial strength. UBS anticipates silver prices climbing to $36 to $38 per ounce by 2025, driven by falling U.S. yields, robust industrial recovery, and stronger demand. Despite recent headwinds, the metal's dual role as precious and industrial could fuel its growth. According to investing.com, silver prices are expected to increase in 2025, according to UBS, which is boosted by lower real rates in the United States and higher global industrial production. This is despite the fact that the metal is struggling to match the increases spurred by the central bank in gold. Silver prices increased by more than 20% in 2024, but they have recently lost impetus as a result of increasing yields in the United States, a strong dollar, and growth concerns in global markets. With speculative short positions expanding and ETF holdings stabilizing following major outflows earlier this year, the metal is trading near its 200-day moving average. This represents a positive development for the market. In spite of these difficulties, UBS continues to retain its positive stance, with a target price range of $36 to $38 per ounce for the year 2025. Although rising yields have been a disadvantage, a decrease in yields might potentially improve the desirability of silver. There is a need for a shift towards cyclical commodities, which UBS anticipates will become more prevalent as the year 2025 progresses. Dual roles of silver highlight its market potential. Despite the fact that silver's association with gold continues to be high, the fact that it also moves in tandem with industrial metals highlights the fact that it serves a dual purpose as both a precious metal and an industrial metal.
In that December, just on COMEX alone, there was 25,642 gold contracts delivered, the second highest delivery volume in almost 3 years. And in silver, it was ridiculously high as well. And so what we're seeing is the insiders, the big money, the central banks, the sovereign wealth funds, they're standing for delivery as the retail investor has been, I think, mesmerized by the shiny objects over there, the Bitcoin and the Nvidia and the Apple and all of these stocks and cryptocurrencies that are posting returns. And I remember Richard Russell saying, if you make 7% a year, you're a rock star. And now gold making 30%, as you mentioned, in a year doesn't excite anybody. And that's very dangerous. But I guess at the same time, what I'm really getting at is you're right. The selling has been stronger than at any time since 2017, but so too has very large purchases by people who understand what's happening. So the person looking to make a profit, which I think is not the reason to buy gold and silver, they're looking elsewhere. The people who are looking to preserve and understand economics, understand that the math, as Bill always says, is moving into an area that is not sustainable. Well, they're contributing larger amounts of money into gold and silver, maybe even first-time clients. But the trend that I see is of the public looking elsewhere as the insiders are draining the exchanges. And that's classic misdirection, and that should portray for higher prices down the road, if I had to guess. I know a lot of the rhetoric surrounding the BRICS nations has somewhat died down. I expect to see a reemergence of this discussion in 2025. Trump saying he'll enact 100% tariffs on the BRICS nations for continuing their desire to move away from the dollar. That's not a tariff. Tariff protects manufacturing, domestic manufacturing. That is a sanction masquerading as a tariff. That is financial warfare. That is not something that I think will dissuade the BRICS from continuing to move forward. I think that from a domestic standpoint, I think the debt issue is something that has to be front and center. I mean, even Trump just sent out a tweet the other night saying, thanks to what the Democrats have done, 2025 could be a 1929 style depression. You look at the latest Treasury data that was just released for November, which was the second month of fiscal 2025. The U.S. spent $584 billion for October and November. That's the first 2 months of 2025 for the fiscal calendar year that Trump is inheriting are officially the worst start to a year ever for the Treasury. When I look at gold acquisitions, again, China doesn't buy gold for no reason. And they've bought 1,000 tons since the start. That's what they tell us, since the start of the Ukrainian war. At the same time, they've sold $250 billion of our U.S. treasuries. This is a trend that will continue. This de-dollarization will continue. I think they'll continue to accumulate gold rather than try to devalue their yuan against the dollar. They'll let it happen organically by accumulating gold. I think that's something certainly to focus on. Of course, it's the bond market. At the same time, I think the bond market, or with the Fed creating trillions to fund these deficits, that not only that they're inheriting, but the debt that is coming due. I think the bond market's getting very nervous that they see inflation coming back, that the ballooning U.S. debt is something that has to be dealt with, and how many Treasury securities will have to be created to do so. At the same time, many of the countries that traditionally supported our debt are moving in the other direction. So I think that's something that we'll have to continue to watch very, very closely.